Ever made a dumb investment move? You're not alone. In fact, everyone has at some point. We've all been there, whether it's a rookie mistake or a slip-up even seasoned investors would blush at. It's a part of the learning curve, the school of hard knocks in the world of investing. But here's the good news. Mistakes are not fatal. They're stepping stones, lessons to be learned, wisdom to be gained. So, what are these so-called dumb investment moves? They're the pitfalls and traps that can be easily avoided with a bit of knowledge, a dash of patience, and a good dose of common sense. We're talking about not doing your homework, putting all your eggs in one basket, chasing hot trends without thinking, and yes, even letting your emotions rule your investment decisions. In this video, we're going to delve into the 10 dumb investment moves you should always avoid. Welcome to Money Funnel, your ultimate gateway to financial empowerment. Get inspired, get motivated, and get practical and actionable advice on how to be financially independent. We are here to support you in your quest for that abundant and happy life for yourself and your family. Please help us grow this channel by subscribing now. Don't forget to hit that like button and notification bell for more financial tip videos. Number 1, not doing enough research. Imagine walking into a jungle barefoot, without a map, and hoping to find a treasure. Sounds reckless, right? That's exactly what you're doing when you skip doing your homework before investing. It's like gambling, not investing. Let's consider the case of Company X. It had a great run last year, its stock price skyrocketed, and it was all over the news. Many people jumped on the bandwagon, investing their hard-earned money without digging deeper. A few months later, the company tanked due to unforeseen financial issues. Those who didn't research lost their investment. Researching can be as simple as reading up on the company, understanding its business model, checking its financial health, and keeping tabs on the industry trends. It's not about predicting the future, but about making an informed decision. Remember, information is power in the world of investments. Number 2, putting all your eggs in one basket. It's an age-old adage, and it certainly holds true in the realm of investing. Diversification is critical in managing your investment risks. Imagine putting all your money into a promising tech startup. It seems like a golden ticket, right? But what happens if the startup fails? Your entire investment goes down with it. Now consider spreading your investments across a variety of sectors. Tech startups, real estate, blue-chip stocks, maybe even some bonds. Each of these investments comes with its own risks and rewards. If one doesn't perform well, the others may pick up the slack. Diversification doesn't guarantee profits or protect against losses, but it does spread the risk around. It's like having a safety net, catching you when one of your investments falls. In conclusion, don't gamble your financial future on a single roll of the dice. So, always diversify to mitigate risk. Number 3, chasing hot trends. Now, we all love a good trend, don't we? The latest tech gadget, fashion style, or even that hit Netflix series everyone's talking about. But when it comes to investing, hopping onto the trend train without a ticket of understanding can lead you down a rocky financial path. Think about this. Trends are just that. Trends. They're hot one moment and ice cold the next. Investing in the latest fad without understanding it is like trying to ride a bicycle with no handlebars. Sure, it might be exhilarating for a moment, but you're likely to crash and burn. So, before you dive headfirst into the latest investment craze, do your homework. Understand what you're investing in, why it's trending, and most importantly, the risks involved. Because, in the world of investing, knowledge is not just power, it's your safety net. Remember, a hot trend can quickly become a cold reality. Number 4, not having a plan. Picture this. You're on a road trip, but you have no map, no GPS, and no idea where you're going. You're just driving aimlessly, hoping to reach a fantastic destination. Sounds absurd, right? It's the same with investing. Without a solid plan, you're essentially driving blindfolded on the investment highway. Let's look at a real-life example. Remember the dot-com bubble in the late 90s? A lot of investors jumped on the bandwagon without a clear plan. They were attracted by the allure of quick profits and the hype around internet companies. But when the bubble burst, many saw their investments evaporate because they didn't have a strategy to manage risks and didn't know when to exit the market. The lesson here? Always have a plan. It should outline your investment goals, risk tolerance, and exit strategy. A well-thought-out plan is your roadmap to investment success. Without a plan, you're planning to fail. Number 5, ignoring fees. Now we've all been there, excited about an investment opportunity, and we overlook the fees. But here's the thing, fees can eat into your returns significantly. Let's imagine you've invested $1,000 in a fund and it grows 10%, you're sitting pretty with an extra $100, right? Not so fast. If the fund charges a 2% fee, that's $20 gone. Doesn't sound like much, Well, imagine that over 10 years with compound interest. Suddenly, you're not just losing $20, you're losing hundreds. Consider high-frequency trading. It involves making numerous trades, and each of those trades comes with a fee which can add up quickly. If you're not careful, you may end up paying more in fees than you make in profits. So let's be smart about our investments. Always factor in the fees. Number 6. Emotional investing. Investing should be based on facts and analysis, but sometimes our emotions sneak into the decision-making process. It's human nature. We feel fear, excitement, regret, and these feelings can lead us down a dangerous path. Take fear, for example. A downturn in the market can trigger panic, leading some to sell off their stocks in a frenzy. But this is often the worst time to sell. Conversely, when the market is booming, greed can take over. People start buying up stocks, hoping to cash in on the trend, but what goes up must come down. Regret can also be a powerful emotion in investing. You might kick yourself for not investing in a certain company when its stocks were low, but remember, hindsight is always 20/20. The key is to make decisions based on logic and sound financial analysis, not on the roller coaster of emotions. Keep emotions out of investing. Number 7. Not understanding the investment. Now, this one's a real doozy. Imagine diving into a pool without checking the depth first. Sounds reckless, right? That's exactly what you're doing when you invest in something you don't fully understand. Take for instance the case of the flash crash of 2010. Many investors, without understanding the complexities of high-frequency trading, lost significant amounts of money in mere minutes. Then there's the infamous story of Enron, where shareholders lost billions because they didn't comprehend the company's convoluted accounting practices. The moral of these stories? Knowledge is power, especially when it comes to your hard-earned money. So, before you put your money into stocks, bonds, mutual funds, or any other investment, make sure you know what you're getting into. Understand the company, the industry, the risks, and the potential rewards. Never invest in something you don't understand. Number 8. Not reviewing investments regularly. Picture this. You've planted a seed in your garden, but instead of watering it, checking for pests, or even giving it a glimpse of your attention, you leave it alone. What do you think will happen? Chances are it won't grow into the robust plant you were hoping for. The same goes for your investments. Just as a garden needs consistent care, your investment portfolio needs regular reviews. The world of finance is always changing, markets fluctuate, and the performance of your investments can vary over time. By keeping an eye on your portfolio, you can make adjustments as necessary, perhaps shifting funds from underperforming assets to those showing promise. This process, known as rebalancing, can help you maintain the desired level of risk and return. It's like pruning your garden, helping the healthy plants to thrive while weeding out the ones that aren't doing so well. Regular reviews keep your investments on track. Number 9. Trying to time the market. Now, this one is a classic blunder, and it's something we've all been tempted to do at one time or another. You know how it goes? You're watching the market like a hawk, waiting for that perfect moment to buy or sell. But here's the thing. The market is a wildly unpredictable beast. Even the most experienced traders can't accurately predict its movements most of the time. And when you try to time the market, you're essentially gambling. You're betting on the chance that you can outsmart millions of other traders. More often than not, this strategy leads to missed opportunities and losses. You might find yourself waiting on the sidelines while the market rises, or selling too soon and missing out on significant gains. In the long run, it's usually more beneficial to adopt a consistent investment strategy, rather than trying to make quick profits through timing. Remember folks, timing the market is a fool's errand. And finally, number 10, not taking inflation into account. Inflation is like that sneaky, quiet villain in a thriller movie. It operates in the background, silently eroding the real value of your investment returns. You might be thrilled to see your investment grow by 4% in a year, but if inflation for the same period is 2%, your real return is actually just 2%. Inflation is the rate at which the general level of prices for goods and services is rising. So if you're ignoring inflation while calculating your investment returns, you're not getting the full picture. It's like trying to run a marathon with a blindfold on. So remember, when you're calculating your investment returns, always take inflation into account. It's an essential part of the equation, and ignoring it can give a misleading impression of your investment's performance. In economics, as in life, what you don't see can hurt you. Inflation is the silent killer of investment returns. So there you have it, the 10 dumb investment moves you should always avoid. We've journeyed together, exploring each pitfall from not doing enough research to trying to time the market. We've delved into the danger of putting all your eggs in one basket and the folly of chasing hot trends without a well-thought-out plan. We've also underscored the importance of understanding your investments and the hidden costs that can erode your returns if you ignore fees. We cautioned against emotional investing and the need to review your investments regularly. And let's not forget about inflation, a silent enemy that can eat away at your profits if not taken into account. These are the 10 cardinal sins of investing, the mistakes that can set you back on your journey to financial freedom. But remember, every mistake is a learning opportunity. Avoid these mistakes, and you're well on your way to becoming a savvy investor. But remember, every mistake is a learning opportunity. Avoid these mistakes, and you're well on your way to becoming a savvy investor. To learn more financial tips, watch the next video recommended by YouTube here. Thanks for watching.